banks. They're always running to the government, give me money, give me money. You know, Paul, what's his name, Hankson or something. So maybe you can get some small business loans. Might as well try. The big boys can get them, and so can you should try too. Another option is sharing employees. So maybe you can't afford to hire someone full time, so maybe this employee could work at 2 different places. Work for one entrepreneur, work for a different entrepreneur. And then that person, by having sort of 2 jobs, effectively gets full-time wages. So you're sort of borrowing, sharing employees. Again, there are different characteristics. This is important, especially when you have to write your own business plan, is picking what makes more sense for your business idea. Personal funding, equity, or debt. Well, you're going to tend to pick personal funding if, for instance, your cash flow statement sucks, or you have weak cash flows, you're not generating a lot of cash from operations. That might tend to lead you to personal financing. Another problem could be, let's say, if you have high leverage, right? So you've borrowed, you've maxed out your credit cards, right? So the bank's not going to lend you any more money, kind of thing. So this means now you're going to have to do all the work yourself. Go back to sweat equity, kind of thing, because no one's going to lend you anymore. Is basically what we're saying. You're cut off. So you're going to have to go back to things like sweat equity, getting your friends and family to help you out, kind of thing. If growth is not too, it's moderate, meaning it's okay but not great, then maybe basically the reason why this is here is because potential investors might be turned off. They might say, well, it's not a high growth business, so why should I invest in you? It's not as attractive. The other thing, of course, is because you're a new entrepreneur, you're unproven. You don't have a track record. So outsiders, those the potential equity investors and debt investors, they don't know whether you're great, you can execute, or you're a charlatan, or you're a criminal, maybe even. They might worry you might take their money and then disappear. Okay, so this is all what in economics they talk about. What's called like the moral hazard problems of investing, and what's the other one called? I forget. But there's like moral hazard and adverse selection is what this would fall under if we were in economics class. Now, debt financing is usually not appropriate at startup, as you'll see in the next slide, but it does exist. One could be a small business loan. This again is probably government backed up, like the Business Development Bank of Canada might be able to help you out. And of course, a lot of these entrepreneurship textbooks are American, so they'll talk about a small business administration. And other options, of course, bank loans, mortgages. Again, that's usually on property, like a mortgage, a commercial real estate kind of thing. And there are also sometimes, they can also, again, for debt, make distinctions between short and long term. Like mortgages might be 20 years. Right, a loan might be 10 years. Other options might be shorter term loans, like lines of credit and so on, from a bank, which is almost like a line of credit is almost like just having a credit card, pretty much. They say you can have like $100,000, and the interest rate is set based on the prime rate plus maybe 2% because you're a little bit riskier or something like this. Okay, and that's pretty much what it is. It's just it's like having a credit card, sort of. However, usually lines of credit have lower interest rates as opposed to like a 29% on a credit card. Okay, let's see. We have characteristics of debt financing. again, you have to remember, talking to lenders like bankers, they're usually more conservative, right? They're concerned about minimizing risk, and of course, entrepreneurship, especially at startup stages, is usually high risk, very high risk. So they sort of, that's why bankers are usually not the best friends of startups without having sort of proven concept. And sometimes they look for collateral. So this basically means if the loan goes south, you default on your loans, they come take your property, your house, your business, maybe your computer systems or whatever, and then they can try to sell them. That sort of protects the bank, right? Because they're trying to minimize their risk. So they want to have some sort of assets behind it. Bankers are worried about, some of those ratios, particularly the liquidity ones. Can you make your monthly payments? So that's why I look at cash flow statements. Are they strong? So are you generating a lot of cash from operations? So these are the guys who are worried if all they see, the only cash flow is being generated, let's say, by selling off your assets. They want to see cash generated by operations, not cash generated. They don't want to see a lot of cash being generated by selling off assets, so that's like a negative investment. They also don't want to see a lot of cash being generated possibly by other financing activity, where they don't want to see every month you're always borrowing from someone else. You got loans at the Bank of Montreal, and then next week you got loans at Scotiabank, and next week you got loans at Royal Bank. They're going to be worried about the fact if there's too many people that you owe money to, because they don't want to have to compete with all these other lenders, right? Of course, the other banks hopefully will be smart enough to see that and not lend to you, because the idea of being a banker is you don't want to have 12 other people competing with you for the assets. You want to be like, ideally, if you're the bank, you want to be the first guy in line, so that if the entrepreneur goes bankrupt, then you seize all the assets first, and then you sell them, and then let the sort of unsecured creditors, that's their problem. They can wait in line. Right? So the idea of being the bank is you want to be the first guy in the pecking order, so to speak. Low leverage, again, balance sheets, you're looking at debt to equity ratios. You don't want this company to burden down with tons of other debt to other people. Again, same point. The other thing, of course, is audited financial statements. So you want to make sure that as a banker you're looking at statements that are in conformance with generally accepted accounting principles. This again creates more costs for the entrepreneur, because the entrepreneur is probably going to have to hire an accountant to do this, right? The idea here is that you want to have basically this accountant, this sort of third party looking at the statements. You're not just blindly trusting the entrepreneur. The entrepreneur said everything is fine, so it must be fine. You want that kind of third party, the outsider, to look at the statements. That's the idea here. You want good management teams. You're concerned about the character of these people. It's like you're lending money to someone as a bank. You want to make sure you're not lending it to some sleazy, slimy person. Someone who's has good character, meaning that they're honest, they're not crooks, they're not going to take your loan money and disappear to some other country. Flee the country and leave the bank with basically a loan that's never going to get paid back, and that they're honest, business people, right? That they, and also that they have some sort of track record of always paying off their credit cards, always paying off their lines of credit. In other words, they're not always late. Like, you don't want someone who's always late on their rent, kind of thing. That's not good. And again, healthy balance sheets. Right, so we don't want to, as a banker, we're going to try to avoid investing in insolvent companies. Remember, I talked about insolvency before, is when you basically have liabilities are bigger than all your assets, so you have a negative net worth. We don't want to invest in that. Right? Part of the reason we don't want that is because